Great. And looks like we are live. I'm just jumping over to messages. Give me a second. Got about 28 people or so right now. All right, and we'll kick off in just a second. All right, so how are you guys doing? Let's see some chat messages, if we could see where you're from. Elgar, live and kicking. Good morning from Wisconsin. Hey, Daryl. New York City, Singapore, nice. France, India, Dubai, Spain, London, nice few people from London, Hawaii. Of course, Elgar's from Amsterdam. Maryland, UK, India, nice. Seattle, Romania, great turnout. This is awesome, guys. So I'll give you a little overview of what we're going to do here, and then I'll kick off the webinar, and then Ryan will go after me. So this is going to be really good perspective. I know a lot of you are customers of Tykr, and maybe some of you are not. So you're going to get a really good perspective from me, my background in investing and how Tykr came to be. And then you're going to hear from Ryan. Now, Ryan will give you a deeper intro. I'll just keep it really high level here. So Ryan is a financial planner. He also has experience with corporate finance prior to this. So he's got a lot of great financial experience as well. But he'll give you the whole story here in a little bit. But I'll go ahead and share my screen in just a second, and we get started. All right, here we go. All right, Ryan, can you see my screen?
I can.
Great. Okay. All right, I'll expand this. All right, so just a quick disclaimer here before we get started. So if you guys do hear any stock recommendations, of course, it's not intended to be buying or selling recommendations. Please either talk to Ryan or myself offline. All right, so just a high level, what are we going to cover? I'm going to touch on, what do you do when a stock goes down? In some cases, if a stock goes down lower than what you bought it for, how do you react? This can be a nerve-wracking situation, but I'll give you a little peace of mind in scenarios like that. Also teach you how to maximize your returns in the market. So we'll get into that whole conversation. Now, Ryan is going to touch on a few of the items below, such as the benefit of holding stocks over the long term, investing in consistent increments, and then how to minimize fees and control emotions. There'll probably be a few other topics there, but I'll just keep it high level. And we'll jump into my background to give you a little context if you don't know my working history. So I've been in software engineering for about 15 years, primarily as a project manager. Some of the companies I've served include GE, Kohler, and Kohl's. For those of you who have, let's say it's a consulting business, or you do marketing for businesses, or you're a project manager, believe it or not, it's a great place to be because you can learn how businesses function. And I'm naturally a curious person. So every company I work for, I didn't just do my job or learn my job. I was always fascinated by how businesses sell. How do they market? How do they operate? What do contracts look like? What do negotiations look like? All these little nuances I didn't have to do, but I always asked, hey, could I be a part of that meeting? And I did that for about 15 years, and not really, earlier in my days, I didn't really see a benefit to it. I was just a curious person. In the end, it allowed me to, at this point in the game, really understand businesses easily. Like, how does the business make money? What is it easy to scale or hard to scale? Can it be a global business, or is it really just going to remain a small business? All these little nuances I wouldn't have picked up if I didn't put myself in those positions. So for those of you who enjoy learning about businesses or have a career where you can ask those questions, I say go full speed ahead, because it can really pay off for your investing career. The last 10 years, I also have been angel investing. I really did it a little more back in 2010. 2011 is where it gets started, and I'll explain the difference here, just high level. So angel investing, there's nothing glamorous about it. It's investing in private businesses, not public businesses in the stock market. And what you need to do is you need to really pay close attention to, what kind of product or service is being offered, how scalable is it. It really comes back to that experience with, as a project manager, is understanding businesses. But there are risks with angel investing. It's you can't make consistent returns. You're really looking for those big wins, and hope you hit like 1,000% return. And I'll touch on some of the mistakes here in a little bit. So I'll keep going. So a question I have to ask everybody is, do you believe stock investing is too confusing, too time consuming, or too risky? Well, you can relax, as it doesn't have to be. So there are ways to reduce risk, save money, and invest confidently, and you can save time. Saving time was the big win for me on why I really enjoy investing in the stock market. So let's get into some of the mistakes I made and what you can learn from those mistakes. So let's get started. So with angel investing and venture capital investing, it really, like I said, it's investing in private businesses, and you lose money 90% of the time. You just hope the 10% that you make money makes up for the losses. So it can be high risk. And in some cases, when you invest money in these businesses, you can't get it back for like 5 or 10 years. So you make a commitment and you have to commit. It's not like the stock market where you could buy shares today and you could really sell them the same day. So it's kind of like you got to emotionally separate yourself from money and commit to investments over the long term. Ryan will talk to long-term investing in a little bit. This is high risk. And with angel investing, you sometimes have businesses that are like brand new or very young, so you don't have historical data, such as your financial statements, such as, let's say, your revenue, your net income, your EPS, your cash, your debts. Like, you don't have access to any of that. And even if you asked for it, it'd probably be pretty messy. So after losing money, and I shouldn't say losing, I kind of broke even after about 5 years, which brought me to 2015. I'm like, you know what? I don't like going for these big wins. I could be at this for a while. And I was just thinking about, how long could I do this and really hit that unicorn investment opportunity that's going to just make a bunch of money overnight. And the chances of that are actually very slim. It's kind of like going to the casino. So I decided to turn my attention to the public market. And here's some of the names that I've known through the years, and I decided to really turn my attention to. So Ben Graham is really a godfather to us all as investors. He was Warren Buffett's teacher or professor at Columbia University, and is also highly respected by Charlie Munger. If you don't already know, Warren and Charlie have Berkshire Hathaway. They've been partners for decades. And that really leads up to this guy at the bottom here, Phil Town, who I consider my mentor. He's given me a lot of guidance along the years on how to manage my own investments, and he's got a few good books, which I'll touch on in a little bit too. So to give you a little context on Phil and why I like Phil is I tend to relate to him. And here's a fun story. So after serving in the military, he was earning about $5,000 a year, not per month. This is per year. This is back in the early 1980s as a river rafting guide. And what he did is he met a few financial professionals that were like, hey, you should get into investing. And of course, he's just kind of laid back guy. He's like, sure, why not? Give it a shot. And they taught him how to turn $1,000 into over $1 million in 5 years. I'll touch on how he did that in a little bit. But Another thing that Phil makes him just a real dude is he drives a Dodge Ram. Like, this guy's done very well, but he's a regular guy. I think he lives outside of Georgia, and he's got a ranch. He's got a few dogs, outdoorsman. I'm an outdoorsman, so I can relate. That's kind of my thing. So again, I really gravitated to the fact that this is not somebody who's trying to be polished. He's just an approachable dude. Here is two books that I read. He does have a third book. I think it's called Invested. He wrote with his daughter, Danielle. I'm sure it's great. But these two books provided a lot of great information, and about 70% of the calculations that went into Tykr are actually from these two books. So if you haven't read these, definitely check them out. So the big question is, when I got into the public market, I knew, and I've read articles on Warren Buffett stating that, hey, if he just was managing a few $1 million, he could make between 15 and 50% per year consistently. And, I actually did some homework on his earlier days, and he was earning, I think when he was managing he had an investment practice, and he had 30% returns consistently over, gosh, I could be wrong on this, but it was 10 years. And the question is, how are they doing that? And I know that these guys, they're not gambling men. They don't guess, they don't use emotions, they're not using feelings, which in my world in software engineering, you kind of break things down logically. This means they're using math. So what I did thereafter is I sought out to kind of understand the math, and I just did a deep dive, as many books as I could read, as well as the YouTube rabbit hole, and started putting everything together in Excel. And I created the first version of Tykr in 2015 and 16. And it would take, believe it or not, it would take me 5 to 10 minutes to analyze one stock. I'd have to pull about 50 data points from the income statement, cash flow statement, and balance sheet over to this Excel sheet, analyze it, and then I could see if the stock was really a good or bad investment. Well, fast forward to 2019, I was using this tool to generate pretty consistent returns that were beating the market. But in 2019, I said, you know what? I should talk to some institutions, financial institutions, as well as some financial planners and some other self-directed investors like myself, and see if they would use a tool like this. And pretty much everybody across the board was like, yes, you should turn this into a tool to share with others. So that brings us to 2020, where we launched the first version of Tykr. And as most of you know, we just launched a new version, which you can see in the screenshots right here. And the big win for me is time. I don't have to copy and paste financial data over from screen left to screen right. And take 5 to 10 minutes per stock. It's all done for me. So that's the big one. But of course, there's another big one with Tykr, as most of you know, is we try to simplify investing, make it much more approachable, easier to use. Try to create a lot of educational content that complements your investment journey. So to give you a little context here, this shows my returns. These are not guaranteed on your end, but that first year I was going for 15% or more, and I did hit that compared to the S&P 500 at the right. 2017, I was a little lower than that S&P. Then in 2018, I had about 80%. 2019 was 35%, and then 2020 was on 20. So I'll speak to 2018 and 2020 real quick. Where you make your biggest returns with value investing, which is what Tykr is based on, is when the market goes down. And I'm going to talk about how to do that in a little bit. And this relates to Phil, how he made his big returns. It's about buying when everybody's fearful. So the old saying from Warren Buffett is, you want to be greedy when everybody's fearful. So when the market's dropping, you want to be buying. So you can see in 2018, there's a drop. Well, what I did is kept buying those on sale stocks, those good stocks. 2020, we had COVID. COVID was a bit of a crash. The S&P 500 went down about 30%, and a lot of stocks went down even more. Well, what I did that year is just buy as the stock market is falling, and when it corrects, that's where you make your big returns. Now, if it's a more flat year like 2017, you'll still do all right, but you make your biggest returns when the market is actually falling. It's kind of contrarian thought process, but that's how it works. So let's jump into some of the hard information here I wanted to teach you guys. So we're going to go through a scenario such as, let's say I bought a stock dropped lower than what I bought it for. It's kind of like that oops moment that can come across, like, what did I do wrong? And you just have to relax. This happens all the time. The market it's like waves in the ocean. It's going to go up and down. You just got to ride it. Now, let's say that same stock changed from on sale to overpriced. To give you a little context here, if you guys don't know, Tykr has a really simple rating system. Stocks are either classified as on sale, watch, or overpriced. On sale means this is a potential buy, and overpriced means it's a potential sell. I use the word potential because you still want to analyze the 4 M's. I'll speak to that real briefly here. So with the 4 M's in investing, you have the margin of safety, the meaning, the moat, and the management. So Tykr does all the math for you and handles that margin of safety. So you don't have to worry about doing any calculus or any calculations, really anything that's math related. This is the easy button. But you cannot calculate the meaning, moat, and management. In Tykr, there's a worksheet that walks you through it, and we do have a training section that kind of guides you along the way. But the meaning, I'll just kind of summarize it. The meaning is really looking at the business and the industry. You got to ask questions like, hey, will this business be around in 10 years? Is this an in-demand industry? Here's an example. When you look at electric vehicles or anything that's electric battery powered, that's probably going to be around in 10 years. When you look at oil, is that going to be around in 10 years? Maybe, but it's not going to be as in demand as electric vehicles. Then you jump to moat. Moat is the competitive advantage over other businesses. So I like businesses that are really hard to duplicate. For example, Amazon has a enterprise platform called AWS. It's a hosting platform. Trying to create a hosting platform like AWS or Microsoft's Azure is really hard to do. It's also called platform as a service. It's very difficult. I've been part of a company that tried to create their own, and they failed miserably. So don't try to create something like that. But then I look at Apple. Apple has a really big cash moat. They have like over $200 billion of cash on hand they can use to innovate, create new fun products. They can test. They can also use that money to withstand downturns. If there's a lot of tech businesses out there that don't have any cash on hand, they can't do that. So a cash moat is really important, and the management can be fun. I'll use an analogy here. Let's say you're like the GM of here in the States, a popular sport is football, American football at least. And if you're the GM, you want to find players that have a winning track record. Like if you're looking for a quarterback, you're not going to go to the local high school. No offense to high school students out there, but you're probably not going to win games at that level. You want to look for the guy that has the experience of winning games, winning Super Bowls, right? And you do the same thing when you're investing in businesses. You want to look at the CEO. What kind of experience do they have increasing share prices, building businesses? If they're really unknown, it's a little bit of a risk, but if they have a track record of winning, that's something to pay attention to. So coming back to our scenario here, when a stock drops, relax. Don't worry. You're going to have a situation where now you just look at the stock, you look at the 4 M's, the meaning, the moat, and the management, most importantly, to determine, should I sell this stock or should I wait it out? And I did this. I'll give you guys an example here. Probably about 4 years ago, I did this with Rollins. Rollins is like a pest control. They create pesticides and whatnot. And they switched from on sale to overpriced. And what I did is I just relaxed, realized that this is a business that buys other businesses like them. They buy their competitors out. They're harder to duplicate because they have so many different products and brands within, and they've been around for years. And I decided, you know what? I'm not going to sell. I'm not going to take a loss. I'm going to ride it out. And I think within about 6 to 9 months, it went back up above the price I bought it for, and eventually went back on sale. And so in this case, if you do buy something, it goes to overpriced, just relax. It's not the end of the world. In most cases, you're going to be okay. And just look at the business. Where's the business going? How's it run? And this will give you good training as well to really look past the numbers and look at the businesses. All right, so let's touch on how Phil Town made his big money, as well as how do I make bigger returns in 2018 and 2020. And that is called stockpiling. So I'm going to jump off of screen share here, and I'll just speak to you guys directly. Give me a second. So with stockpiling, and this is something that when I was reading his books, it was kind of like the aha moment. How do you, because it made perfect sense. If the market is falling, but you see on sale businesses fall as well, that's like, it's like a flashing light saying you've got the opportunity to make some money here. And these opportunities don't happen too often. Like you look back, COVID was a nice little dip. But prior to that, the biggest dip was the recession in 2008. I mean, we're looking at like almost 10 years plus that opportunities like this come around. And I know for a fact, and I love to talk to Phil someday and learn what specific stocks he bought, but those are the opportunities that can make the biggest returns. I'll give you an example here of one of the guests I had on my podcast, and Ryan was on my podcast, I think a few months ago, but this guy's name is Clayton Allen. He teaches Forex trading. He advises you not to really get into trading, but he was telling a scenario where in 2008, market dropped and all the automotive companies in the States like Chrysler and GM, they took bailout money from the government. The one company that did not was Ford. And he had the rationale to say, hey, if this company's not taking a bailout, that means they've got a strong financial statement, or they got a strong business financially. And he bought a bunch of stocks when it was really close to the bottom. And I think it was, to give you the hard numbers here, it was close to like $100,000 he put in. And I think within about a year and a half, 2 years, he could correct me on this, he turned that into like 2.5 million. I asked him if he retired. He said no, but he definitely could at that point. And I think he was in his 30s when this happened. So will opportunities like that happen to us? Not all the time, because recessions and crashes don't happen too often. But when they do, you should get really excited. And fortunately, Tykr, it watches those on sale stocks for you. So when the market drops and I see stocks drop, like with COVID, just keep buying more. It's pretty simple. So yeah, I think that kind of summarizes up my portion of the webinar here. I think we're about the 24-minute mark. But I'll hand it off to you, Ryan, and then what we'll do at the end is we'll leave this open to open Q&A for you guys. So go ahead, Ryan, take it away.
Great. Thanks so much, Sean. I really appreciate you bringing me on here. So I'm really going to reiterate a lot of what you spoke about here. And really the gist of my portion is going to be, how do you beat 90% of the pros with very little work? And believe me, it is possible. So let me just pull up my presentation here. Sure. There you go. All right, you guys see it?
It looks like it's loading. There we go.
All right. All right, so you can see the screen?
Yes.
Perfect. So first, just a little bit of background on me. I've been in the wealth management business for close to 20 years now. Today, I run an independent wealth management firm called Future You Wealth. And at Future You Wealth, the way we can think about how we serve our clients is we basically help clients build and grow wealth over decades. Before starting Future You Wealth, I spent a number of years working at some of the largest firms in the industry. I worked at Goldman Sachs. I worked at a large global investment firm called Capital Group. I started my career at a large global investment firm called AllianceBernstein. So I have experience working at big firms, small firms, everywhere in between, a chartered financial analyst. I had a book released last year called You're Making Other People Rich, which a lot of what I'm going to speak about today is included in that book. And then finally, to the extent that you want to hear more, you can go to YouTube. I gave a TED Talk in late 2020 talking about financial independence, and really very, very similar to what we're talking about today is the simple path to financial independence. Okay, so I want to boil it down to 3 rules for making money in the stock market. And that is hold your stocks over the long term, invest in consistent increments, and then minimize your fees and emotions. A lot of this Sean just covered. I'm going to look at it through a slightly different lens, but the theme is very consistent. Okay, so number 1, think about something of value that you own. It could be your house. It could be a small business that you own. It could be a collectible. Just picture in your head something that's valuable to you. Okay, now I want you to imagine that there's someone in your living room with a megaphone, and between 9:30 a.m. and 4 p.m., they are yelling into that megaphone the price of that thing that's valuable. So if it's a collectible, and let's say it's broadly speaking worth $1,000, between 9:30 and 4:30, 9:30 and 4 p.m., they're saying now it's worth 900. Now it's worth 1,100. Now it's worth 950. Now it's worth 1,050. You get the gist, right? That would drive you absolutely insane. So number 1, you'd probably tell that person to get out of your living room. But number 2, if the person yelled out a price that was lower, well, would you rush and sell immediately? No. If they yelled out a price that's higher, would you want to sell to realize the profit? No. It's something that you own. It's something that you value. It's something that you want to hold on to for a very long time. I use this example because this is the stock market. The reason people get so confused with the stock market, and the reason it brings so many emotions, is because between the hours of 9:30 a.m. to 4 p.m., Monday through Friday, price discovery is happening on a second-by-second basis. It is just noise. If you go through if you go through Tykr and you build a portfolio of stocks and you're committed to those stocks, they're really good companies, they have strong moats, they have strong balance sheet, they have strong growth prospects, and on a given day, whatever reason the market feels like it's 1% lower than what you bought it for, so what? So what? Don't fall into the trap of succumbing to the noise and the headlines on a day-by-day basis. That is probably the biggest mistake people make. Okay, so let me share some data with you to show the power of holding stocks over the long term. So from 1950 to 2020, the stock market, I'm talking broadly speaking US stocks, and I know there's some people from overseas. I'm more or less going to talk about the US stocks. I would say the global stocks are very similar in terms of these numbers. So from 1950 to 2020, the stock market has been up 56 out of the 71 years. That's 80% of calendar years. On a given day, the stock market's up about 50% of the time. So on any given day, it's a coin flip whether or not stocks are going to be up or down. If you extend that time out to 3 months, the stock market's up about 2/3 of the time. And over a 12-month period, up over 75% of the time. And I will say one thing that's not included here, if I were to spread this out over rolling 10-year periods, the market is up around 99% of the time. So if you have a 10-year holding period and you buy stocks that you think are, again, solid companies, good moats, everything that Sean just mentioned, and if you can just hold for 10 years, the chances that you will make money are about 99%. But you have to be prepared for short-term losses. So over the last 71 years, the market has dropped 10% on 38 different occasions. So the translation is you should expect a peak to trough of loss of more than 10% to happen at some point within the next 2 years. I can tell you from my clients, I tell my clients to expect a peak to trough loss of around 10% in every calendar year. It's unsettling, it's unnerving, but really if you have a long-term orientation, again, it's just noise. And as Sean mentioned, these pockets of volatility, these corrections defined as a peak to trough loss of 10%, a bear market is defined as a peak to trough loss of 20%. These are actually gifts for long-term investors. If you have more money, that is a great opportunity to accumulate more shares. And recoveries are actually pretty fast. So since 1950, the average time to recovery for a loss of greater than 10% is 6 months. So the people, the way you think about it, and it's funny, I was watching CNBC the other day and the market was down, 2% or so. And the commentators were saying, oh, this is the worst day since February, I'm making this up, February 18th. And I thought about this, I'm like, okay, so February 18th, the market was down 2% and everyone was panicking. I don't remember what happened on February 18th. I don't remember what I did. It's a distant memory. And I think about all the people that sold in a panic. Chances are they didn't get back in. The market increased between February until this most recent round of volatility. The market increased around 12% during that time period. So if you sold on the panic of that date in February and got out of the market, you then would have missed out on a 10% plus return. That is not uncommon. So when you see the market volatile in a given day or a given month, look at it as a gift. That is a time to be buying more. Okay, so now I want to go into point number 2, which is invest in consistent increments, which is more or less what we're talking about here. But instead of just buying on the dips, what I would propose is buying in monthly or quarterly installments. So I'm going to walk you through a case study of what I mean by this. So Jody started her investment journey in June of 2006, and this is a real story. So in June of 2006, she graduated from college, and she said, I am going to commit to saving and investing $500 at the end of each month and buying an S&P 500 index fund. She's not someone who wanted to spend time managing a portfolio. She wasn't working in finance, so she just wanted to make it easy and simple. $500 a month goes into my investment portfolio, and I buy an S&P 500 index fund, which is basically a fund that buys the largest 500 companies in the US, and just make it as simple as that. Okay, so let's look at her journey. So after year 1, she had a balance of around $6,500 after total contributions of $6,000. So no, certainly not bad. She's making money, but definitely not life-changing. Okay, but she just kept up with the process. At the end of year 2, she had a balance of $11,072 after total contributions of $12,000. So if you see, she started in 2006. We're talking about now 2 years, we're getting into 2008. And 2008 was a horrible year for the global economy and global stocks. And at the end of 2008, she had a balance of $9,500 after total contributions of $16,000. So she easily could have felt very discouraged. She could have said, oh my goodness, I want to be done with this. I don't want to invest anymore. This is a rigged game. This is a losing proposition. But she didn't. She kept it up. $500. She didn't. So what Sean said, I think, is a great point, in that when the markets are at a when you're in a record bear market, like 2008 into 2009, that was a time to load up and buy as much as possible. She didn't do that. She just kept buying $500. So she was buying into the volatility, but just stayed consistent with $500. And fast forward to the end of 2020, she had a balance of $230,000 after contributions of $87,000. So think about that. $500 a month starting in the middle of 2006 to the end of 2020 accumulated, went up to $230,000. Now, I tell this to people and they think about money they've wasted over the years. $500, saying, gosh, $500 is a pair of shoes and a dinner out that's not necessarily that memorable. I mean, most of us can figure out how to find $500 a month. And again, looking at what that can accumulate over time, if Jody keeps this up, which I know she will, she's easily going to be a multimillionaire just through a process of $500 a month and investing in an S&P 500 index fund. Okay, so number 3, be mindful of fees and emotions because they matter. So first, let's talk about fees. So most financial advisors charge a percentage of assets under management. I've seen advisors charge 1.5%. I've seen 2%. I've seen all-in fees that have been up to 3%. I would say there are, again, I'm a financial advisor. I charge under a percentage of assets under management. We are under 1%. and we were under 1% because I can't in good conscience charge someone more than that, knowing how much that's going to erode their returns over time. So it's really important to know if you work with an advisor. I think there's a lot of merits to working with an advisor. They help you with the planning. They help you with accountability. They can basically take the emotion out of it. We'll talk about emotion in a second. So I'm not saying don't hire a financial advisor. I'm in that business, but you want to be mindful of fees. So here's an example of someone starting with $50,000 and they contribute $1,000 each month. Let's say their advisor charges an all-in fee of 2%, which is not uncommon. Well, at the end of 40 years, they would have a balance of $1,890,000. Not bad. But what if their advisor charged an all-in fee of 1%? Well, at the end of 40 years, they would have $2,540,000. That's $650,000 more. I mean, fees matter, and just 1% on an annual basis is something you should pay attention to. And again, if you're going to work with an advisor, or if you're going to invest in a mutual fund, you have to pay attention to what you're paying that advisor. And then the last one, and this is probably the most important, is emotions. So there's an economic consulting firm called Dalbar, and every 5 years or so, they put out a study. And what they look at is, okay, what did the stock market do over 10, 20, 30-year periods? And then what did the average investor do? And they have a cohort of people that they follow. So ending in 2006, in 2016, the stock market returned right around 12%. And the average investor in 2016 returned around 7.26%. Okay, how about the 10-year period from 2007 to 2016? Well, the stock market returned on an annualized basis around 7%. The average investor, around 3.5%. Okay, what if you then extend out the period 20 years, so from 1997 to 2016? Well, the stock market annualized at a rate of 7.68%. And the average investor, 4.79%. And then finally, this one is really shocking. Over the 30-year period from 1987 to 2016, the S&P 500 annualized at a rate of 10.1%, which is really phenomenal. But the average investor, 3.98%. That means the average investor is losing around 6% a year. And on an annual basis, that really adds up. And you just look at 1987 to 2016. I think the reason you're seeing that huge disparity is, and some of you might know this, 1987, we had a major stock market crash in the fall. So what I suspect is a lot of these investors sold into that panic and probably waited a while until they bought back in. And they probably waited until the market climbed back up. So then fast forward to the end of the 90s. So 1987, we had a big crash. And then at the end of the 90s, early 2000s, we had another market crash where the market peak to trough dropped around 50% over a 2.5-year period. So those people probably who sold in 1987, they probably bought at the end of the 90s when, okay, now things feel really good, just in time for the market to drop 50% again. And then they probably said, okay, I'm out this time. Then 2003, the market was up around 30%. 2004 was a good year. 2005 was a good year. 2006 was a good year. So then they probably say 2007, okay, now I'm going to get back in just in time for 2008. And they just repeat this process. So let's put dollars to it. So if you had $100,000 and you invested at the very end of 1986, just $100,000, did nothing else, just invested in the S&P 500 index fund. At the end of 2016, you would have a portfolio of $1,820,000. So how about the average investor that annualized at around 4%? Well, the average investor, 100,000, the end of 2016, 322,000. The average investor ended up with $1.5 million less than the person who just held on to it over the 30-year period. I mean, that is enormous. So you see, emotions are the biggest threat to your future wealth. So in summary, rule one, buy and hold. again, I'm a proponent of index funds, but I'm also, Tykr is an amazing tool. I've recommended it to some of my clients. And I think building a diversified portfolio through Tykr, I think will have very similar results. Rule two, invest in consistent increments over time. I showed you the example, $500 a month can make a huge difference over time. If you don't want to do $500 a month, you could do $1,000 every 3 months. Let's say you can only do $200 a month. Just do whatever you can do. The key is to be consistent. When the market's up, put it in. When the market's down, put it in. And just again, keep that consistency. And then 3 is minimize fees and emotions. It's not what you earn, but it's what you keep that matters. And again, emotions are the biggest eroder of wealth over time. I can tell you, if you follow these 3 rules, you will beat 90% of the pros with very little work. The data doesn't lie. So with that, I am going to stop the share here. And that is it for my part. Yeah, we can jump into the Q&A.
Just a few comments there. I love the stories and the examples there. Some of the data you shared, I was like, oh, that's brilliant information. So thank you. And I've got a fun story to share, and some people may have heard me say this one before, but there's a story about a guy by the name of Ronald Reed. He was a janitor that amassed $8 million over the course of his life. Question is, how does a janitor do that? Well, to echo your comments there, Ryan, is he just bought really good businesses, and he did buy some index funds as well, but he just committed to them. He didn't emotionally like sell and enter and exit like a lot of people think they need to do. He just kept buying, and like you showed, compound interest over years just kept building. A janitor, $8 million.
I have a client of mine who is he works for the New York Metro Transit Authority. He's a train operator. He has a portfolio close to $2 million, and it's the consistency of adding a certain amount every single month. He's been doing it since the 1980s, and it adds up over time. This is a guy, again, if you're taking the subway in New York City, he's one of the operators, and this is a guy who's liquid $2 million.
Wow. Impressive. And I've talked to people like, have the discipline to treat your investing like you do your rent or your mortgage or your re-energies bill. Like what I do is I use TD Ameritrade is I've got an auto deposit set every month, and it's mandatory. I have to pay my broker account. There's no ifs, ands, or buts. This is happening kind of like your cell phone bill, right? Or your energy bill. You have to pay it. I have to pay my broker account. So I like that example of that woman that was just going $500 every month. And you're right. You can squeeze. You can find ways to squeeze more money into that account every month.
Yeah, it's easier than you think. Yeah.
Yeah. Stop buying expensive meals or a 5th pair of shoes or another gadget, right?
Yeah, that's right.
So well, cool. Let's open it up here. Any questions you guys have, please enter in the chat box, and Ryan and I can take it from there. So ask us anything, really.
Sean, we have some questions already in the chat. Should we go through those?
Sure. Did you scroll up? That's probably what I'm missing.
Yeah. So here, I'll read some of them. Sure. Sean, so I don't know if this is the most recent or if this is the oldest. So I'll just read in order here, and hopefully we get to all of them. Sean, you mentioned holding around 15 stocks in the portfolio. How can one select the right stocks with a risk appetite of moderate to aggressive risk?
Right. I still recommend in that case, go for on sale stocks in Tykr. If let's say it's 15 stocks and you want to go for a few growth stocks, Tykr really doesn't visually calculate what a growth stock is, but you can kind of determine if you do a 4M analysis. Like for example, I hold a growth stock. Team is the ticker. It's Atlassian. They're based out of Australia. They are overpriced in Tykr, but I call them a growth stock, not a speculative stock, because they do check the boxes when it comes to meaning, moat, and management. Essentially, I'll keep it really short here, is they're a tool for software engineers. In any business out there that has software engineers, where today most do, most cases are using tools like Trello and Jira, which are Atlassian products. So 15 stocks, keep it focused, highly weighted with on sale, but you could go a few overpriced if you want to play a little more aggressive there.
Yeah, I will say too, just to add on to that, when you think about risk, risk is a fascinating concept, and there's two different types of risk when you talk about with respect to investing. There's the risk of losing money, and that's where you put in $1,000 and the market goes down, and now you have less than $1,000. I don't really consider it losing because it's going to be volatile, but let's just call it losing for the sake of this example. So there's the risk of losing money, which is the risk that most people think about. But there's another risk that we don't talk about enough, and that's the risk of missing out. Mm-hmm. So when I think about risk, I want to match the duration of the funds with an appropriate with the appropriate portfolio. So what I mean by that is, if you have, just make this up, $10,000 and you're going to need it in the next 6 months, or there's a chance you might need it in the next 6 months, that money is most exposed to the risk of losing. So that's where I would actually have those funds in something very liquid, very conservative. Those funds I really wouldn't even think about investing. But if you have a 10-year time horizon, now the risk you're most exposed to is the risk of missing out. So take two people with $100,000 and let's say they have a 20-year time horizon. One person just holds the fund in a very conservative portfolio. The other person invests in diversified stocks. Well, over the 20-year period, it's highly likely the person who owned the stocks is going to have a portfolio far in excess of the person that was conservative. Whereas that person conservative might actually not be set up well for retirement because they didn't have the growth. So when you think about time horizons that are longer, the biggest risk you are exposed to, the riskiest thing you can do is actually being too conservative. And I will say just one more thing about 15 stocks. Mm-hmm. I think the biggest risk I see some people making is they think buying a portfolio of 30, 40 stocks is actually less risky. And in certain respects, it's actually riskier. And that if I'm comfortable people going to 20, 25 stocks or so, but you actually don't want to be too diversified. And if you do want to go the path of owning 50 stocks, I would just buy an S&P 500 index fund.
Yep. Mm-hmm. Right.
All right.
Great explanation there, by the way.
Okay. Tykr doesn't recommend for short selling, right?
Correct. And then I see another question here from Nick. It looks like to help with day trading. Nope. Tykr is all about investing. There's actually an article in Tykr that explains the difference between investing and trading. Quick summary is trading is a job. You have to work for it, whereas investing, money's working for you. So I like investing because the money's working for me. I don't have to go work for it. So yeah, you should check out that article if you got a chance. You could probably just look it up on our site.
So what about this? Thoughts on pulling profits from on-sale stocks to build your cash to be ready for buying opportunities?
Well, it's doing it automatically. So as let's say your stocks continue to build, that cash is still in your broker account, just building with it. And what you could do at that point is, let's say there's a stockpiling opportunity. You could sell some of those shares at that point and immediately go into other shares. But I don't recommend you build, sell, hold in cash. Just keep them in the same stocks, as Ryan was speaking to, is just like his examples, just keep holding that money in the same stocks you bought. Let that compounding momentum build in your favor.
Okay, how about this? What if some of the stocks you own go down more than 10%?
Well, my answer there is, what is the status there, and are they on sale or overpriced? Now, if they're on sale, that's your opportunity to buy more. Of course, look at the meaning, moat, and management. And I will say this, what I like to do is when stocks go down, I immediately like to check the news. What's going on? Was there a big market event? If so, that's a really good sign. Like, that's what you want, because it's typically not your business. But if it's your individual business and it's dropping 10%, even if it's on sale, let's say it's, here's examples, like a legal issue, a regulatory matter of some sort, or a CEO sends a stupid tweet, like, you should be warned. In that case, if you're lower than your cost basis, meaning you're lower than the price you bought, I have in the past, I've still held on. But if you're still higher than your cost basis and you can make a profit and there's legal issues, that might be the time to get out. I see this with pharmaceutical stocks. I don't get into pharma stocks too much because there is a little more, Ryan, you maybe have more experience there than I, but it's a little risky because of the legal rigor around the government is, it can cause these to be more volatile.
I hate pharma stocks. I think with pharmaceutical stocks, I think what I have a hard time with is they oftentimes, especially with some of the smaller cap biotech, they tend to be binary bets, and they get approval or they don't. And if they get approval, then the stock can go up. And if they don't, which does happen more often than people think, the stock goes down significantly, and sometimes it goes to zero. So I don't like putting my money in the hands of binary bets. I'd rather, to your point, I think you did a great job highlighting the moats around the business. I just don't think you have a lot of moats around that. Somebody asked a really good question, which I was curious about too. Sean, your results over the years have been outstanding. Were all of those from Tykr?
Yes, 100%. Yep. Yeah. When I first started using Tykr, again, that Excel sheet, it was a time-consuming process. I'd actually set aside a few hours, not every day, but a few times a week to analyze stocks, and most would be overpriced. But when I'd get a few on sale with this clunky version, I would go into those stocks, and some of those I still hold today. If one feature in Tykr is the Sean's portfolio. So it's kind of like the put your money where your mouth is feature, so you can actually see what I'm investing in, and you can see like one of the big players there, of course, is Microsoft, but there's a few others in there that you probably have never heard of.
How do alerts work on Tykr's watch list? What should you do if it goes from sale to overpriced? Will I be notified by email, or should I hold and sell?
Yes, this is a feature we're working on right now. So yes, if you're a pro user in Tykr, you can be basic or pro. If you're pro, one feature that we're working on as we speak, this is a big priority, is to be notified when your summary changes for each stock. So if it changes from watch to on sale, or on sale to overpriced, or any direction, you're going to get notified. We're also, speaking of alerts, we're also working on another feature where you can create your own alerts when stocks go to like a certain price. I know your broker accounts can do this too, but let's say you want to set a price target of like, Apple at 170. When it reaches 170, you get a notification saying, hey, this just changed to, or it just hit the price target you set at, and you can make a decision from there. Regarding, to echo your comment there, let's say you have an on sale stock, changes to overpriced. You're higher than your cost basis, means you made a profit. That, in many cases, can be a great time to exit that stock. I've done that in the past.
One thing to think about too, though, with exiting, to the extent that these are in taxable portfolios, timing matters, right? And of course, taxes matter. So, one thing I will say is, if it goes to, so let's walk through that scenario where you're above your cost basis, and let's say if you held the stock just another couple more weeks, it would go to long-term capital gains, as opposed to short-term capital gains. You have to think about that, right? So it could make sense holding the stock just for a couple more weeks, a couple more days, whatever it may be, and also thinking about the calendar year, right? So especially if you have a situation where a stock goes long term at the end of December, let's say it's December 1st, the stock goes long term on the 17th. If you sell on the 18th, you get the long-term capital gains treatment, but it might make sense to wait into January, because then you delay your taxes for another year.
Right, totally. That's one thing a lot of traders don't think about, is the erosion of profits due to short-term taxes. And I know, depending where you live in the world, your tax rate will vary, but here in the States, that is something a lot of investors are very conscious of, especially as you start building your portfolio. Hitting those short-term gains is not advised. It's the long-term lower taxes, of course, you want to go for. Great point, Ryan.
So let's see a couple other ones. How does Sean decide? I like this question. How does Sean decide on the percentage of each stock in his portfolio? Will we get that feature on Tykr?
So Sean's portfolio doesn't reveal the actual, actually does show the percentages of allocation within. Yes. So you can see like the weighting of each. But what I like to do is, it really comes down to the 4 M's. Like if it's on sale, that box is checked. But then I'm really looking across the board at, the meaning, the moat, and the management. And I'll speak to an example here. And again, goes back to the disclaimer. This is not a buy or sell recommendation, but you look at a business like Microsoft. Let's just do this is going to be a high level forum analysis. I know few people have been asking for this, but here we go. So Microsoft they have B2C revenue with their Microsoft Office products. Like I'm using a computer now. So you get your Excel, your Word, PowerPoint, all those you're paying a license for. You have your Windows operating system is pretty much installed on most PCs, not Apple products, but PCs. So there you go. There's another revenue stream. Then you jump over to enterprise. You've got your Azure product. This is businesses, and this is my background in tech, is when you pay for an enterprise software, you're paying hundreds of thousands on up to millions of dollars per year for one customer can be paying that much. It's highly lucrative. Then you jump over to video games. You've got Xbox. Then you've got your Surface. You've got hardware. And you've got advertising on LinkedIn. They've got all these different revenue streams that are extremely scalable all in one business. So when you're looking at businesses, look at the revenue streams. How does it make money? And start to draw your conclusions there. What you're doing essentially is you're looking past the numbers and you're looking at the business. You're making that transition. As I've said to people, you're no longer a stock investor. You're a real investor. And that's what Tykr is teaching you to do. So that's where the weighting really comes to. And I'll touch on when we look at the moat, how hard is it to duplicate Microsoft at this stage? Good luck. Right? To get that many revenue streams under one umbrella? No, it's at this point way too difficult. And then you look at the management. Satya Nadella is a rock star. He's been doing great work for years. He's highly respected. And a fun story on him, this is really cool, is when they're interviewing for the new CE role, the board of directors was asking the question, why should you be CEO? And he was the only guy that turned around and said, do you want me to be CEO? And that was enough right there to there's just a hint of humility and in that question and lack of pride that just kind of handed off to them. Like, it's your decision. I'm not going to sit here and sell you on it. You should already be sold. You got the role. There's probably more to it than that. I'm probably oversimplifying, but it's things like that, like hints of humility, lack of pride that I look for in CEOs that make me say, all right, I can get behind this person.
Mm-hmm. Yeah, I think that all really good points. And I will say that, it's interesting. One thing you hear a lot about today is, the market's vulnerable because of the concentration in big tech. And if you look at, I think a lot of it is, people are going back to the late 90s and the technology bubble crashing and, some of the scars from that time period. But when you look at big tech today, to your point, when you look at Microsoft, you could say very similar comments about Google, about Apple, about Facebook, about Amazon. Yep. These are companies that are incredibly innovative. They are cash flow machines.
Yes.
And they've been really good allocators of capital. So, one thing, and this is what I really like about your tool, Sean, Tykr, is that, people, you look at Amazon, for example. I've known so many people over the years who've said, oh, Amazon is way overvalued. Like, how could you buy Amazon at these valuations? It's like, well, that's because they could have a profit, an accounting profit if they wanted to, but over the years, they've taken that cash flow and they've invested in Amazon Web Services, which is a huge component of the revenue stream now. So you can't just look at the price to earnings ratio as a proxy for if a stock is over and undervalued. There's a lot of other components to it. So to your point, it's, what are the moats around a business? What's their ability to generate cash flow? But then how are they using that cash flow? And are they using that cash flow to fuel future growth? I know some people I talk to love, they become obsessed with dividends. And I'm not saying dividends are bad. I think dividends are a really good component of total return. But, I take a company like Amazon, for example. Investors in Amazon have been well served by not accepting a dividend and instead allowing Jeff Bezos to use that cash instead of giving it to shareholders, investing in the future growth of Amazon, and stockholders have been rewarded.
Love it. Yep. Great points on dividends there. Yep.
Here's an easy question. Does Tykr advise on IPOs?
Yeah. So we've got another article in there. IPO stocks and penny stocks are kind of related. I'll give you the summary here. So a lot of IPO stocks will not show in Tykr because Tykr analyzes 5 years of historical data. What it does is it looks at 50 data points from the income statement, the cash flow statement, and balance sheet. And a lot of IPOs haven't released that information yet. So if they don't show in Tykr, that means, and it's not on the exchange, it's usually on the company. In many cases, it's the accounting departments, and really stemming down from the CFO is what data will they release? And sometimes you just got to wait. Sometimes they tend to release more data, but IPOs are typically really risky. You're going to see a pump with an IPO because of emotions from a lot of retail investors like us. There'll be a little bit of pump from other hedge funds, but then the first financial statement that comes out, it could be the quarterly or yearly, and that's going to be the moment of truth. It's going to reveal bad financials, and guess what happens? The big institutions start selling, and it's a snowball downhill thereafter. So if you go into IPOs, you better know that business inside and out, and you better know the financials, but just be careful. I know Phil Town has said he usually waits over a year after an IPO. You could wait months, you could wait years, but I just say be careful. Similar to penny stocks, really risky. And I'll give a quick point here, and you might have comments on this too, Ryan. And I've got an article saved on this. 99% of stocks that fall less than $5 US dollars never rise above $5 ever again. The reason is large institutions are no longer entering that stock. It's just going to be retail investors playing with it, and it's never going to move. Now, if you drop less than $10, you're kind of getting into risky territory. Stocks can rise above, but I found based on my homework, 90% of the time, if a stock falls less than 10, it really stays there. So this goes to a lot of unknown IPOs. They will arrive at a share price less than 10. In that case, kiss it goodbye. That stock's probably not going to go above 10.
Yeah, I think if you're trying to make money off of penny stocks, I would say the game is very similar to the one you outlined with respect to angel investing. You're going to lose 90% of the time, and you're hoping that 10% basically outweighs all the losses you're going to have. It's an emotional roller coaster. I do not think that's the best way to build and compound wealth over decades.
Nope, agreed.
Here's a new one. After the update, I can't seem to find some stocks that were on sale. I've invested in them. Will they be back on Tykr?
Yeah. So what we did is from version 1 to version 2 is we went from a data partner called Intraneo, which gave us about like 5,000 stocks, primarily US, some non-US stocks. We switched to financial modeling prep, which gives us about 13,000 stocks around the globe. So that's why you see stocks from like Canada, UK, France, Germany, India, China. Now, if there's a stock not showing, just be patient. Those companies that you once invested in, they should be releasing that data soon. If you do have any specific stocks you want to share, and we could do a manual analysis and see how they're doing. And that's one thing in the Tykr training is we teach you don't even need Tykr. Like you don't even need a screener. Like we teach you how to read the financial statements manually on your own. And what we could do is jump over to like Financial Modeling Prep or Yahoo Finance, Market Watch, whatever, all free sites, and look at that data to see really how that stock is performing. So in other words, be patient, or if you don't want to wait, send me a few of those stocks and I'll take a look myself. For some reason, it's not as refreshing as fast as yours, which I guess it's okay. Thanks for reading these off.
It helps to have two of us.
Yeah, right.
Let's see if I've missed any here. I think
I see a question from a gentleman, Matthew Hansford, asked what tools are coming out. This is a fun one. I'd like to share this one. So Tykr is coming out with a lot of fun features. One of the big ones we've been working on, and it's been on our radar for, close to a year, is a historical chart that shows the points in time when stocks change between on sale, watch, and overpriced. So you can see visually, like if it changes to on sale, does it go up? And of course, if it changes to overpriced, does it go down? Well, you'll be able to see that with stocks. So you can really see the proof in the pudding. We have been playing with a beta version. Elgar, who's on the call, who's our CTO, he's he's taken the algorithm, really added the rigor to it and kind of leveled it up. But he came up with a prototype, and him and I were looking at that. And most of the time, it's so cool to see like a change is on sale. It does indeed, in most cases, it does indeed go up. So it is pretty fun to watch. So that feature, you can save your filters is another. We'll be showing like top movers, top losers. We'll also be coming up with like stockpiling alerts, dragging columns back and forth. That's coming down the road. But yeah, we've got a lot of good ideas, and of course, you guys are really our a big part of the process here, because you add the ideas and you give us creative suggestions, and we like bringing those to life. So keep those ideas coming. I see a question here from Chris. What's a good method for selecting stocks to buy with Tykr when you're first starting? So you could start when you first log in. You could go to my portfolio, see what I invest in. You could go to, there's a little button for on sale, or I think it's top 50 on sale, which is a top 50 on sale stocks. To give you a little context here, if you guys don't know, Tykr has its, on sale washover priced. It's got a point system from 0 to 20. The higher the points, the safer the stock, safer the investment, meaning less risk financially. And then there's the margin of safety. The higher the margin of safety, the higher potential returns you can make. Of course, you should always look at the 4Ms as well. But I would look for you, if you're just getting started, probably look for businesses that have a higher points. That means their income statement, cash flow statement, balance sheet are like rock solid. So that'll help you minimize risk.
Yeah, I'll add to that. I think it's tough building a portfolio, right? And there's so many different options. You have to, in certain respects, you have to have a wide lens, but you also need to just have conviction in what you're doing as well. And one thing you hear about is just invest in what you know. I agree with that, and I disagree at the same time. And I'll tell you why I agree and disagree. I think in terms of building out a portfolio of 15 to 20 stocks, let's say, it's helpful to, especially knowing that you're going to experience volatility, it's helpful investing in stocks that you have familiarity with, the products that you use. You can see the value in them. Like I talk about Apple, for example. When Apple's having a down day, I'm not really worried about Apple, because I can go out to my living room and I can see 5 Apple products without trying that hard, right? And I suspect that that's the case for a lot of people around the world.
Yeah.
But one thing that you have to be, and this is why that can be somewhat tricky, is, I see people coming to me saying they get really interested in certain industries, for example, and they say, oh, this is an incredible industry, and they want to own stocks in the industry. Mm-hmm. Just because an industry is trending or on fire doesn't mean those are investable companies. And what I mean by that is there could be a really compelling, like, for example, one thing that comes up a lot in the US right now is the cannabis industry, marijuana stocks. Mm-hmm. And the marijuana stocks have gotten crushed in the last 6 months or so. And the reason being, it's just become incredibly competitive, and it's hard to tell who the winners and losers are going to be. And it's one of those things where sometimes industries get so competitive that everyone's kind of a loser, right? So sometimes it's actually a benefit to invest in really good companies that are in industries that aren't actually trending and own that space.
Yep. Yeah, good points there, Ryan. And with Tykr's onboarding, which for everybody, you can just go to, right, the Tykr website has all 21 tips. You don't have to be a customer of Tykr. You can just read them all. It talks about it, keep a focused portfolio between 10 and 15 stocks, but try to diversify over some sectors. So, get a few in tech. Now, I hate to say it, most of my stocks are in tech, but I grew up, or most of my career has been working in tech. So I have kind of a really strong balance between B2C and B2B enterprise tech. I like that balance. But anyway, go into some tech or go finance and energy. It just, you create a little diversity there. Like Ryan said, is don't go all in on one industry. That can be risky in itself for sure, especially pharma.
Yeah. Yes.
Yeah.
Stay away.
Yeah.
Yeah, I think we got through everything. I think more comments coming in here.
Okay.
Any other last questions from people?
Give it like a minute here, otherwise we can sign off. Anything else pop up on your end?
No, nothing's on my end.
Okay.
I just want to say, Sean, I really thank you for including me on this webinar today. All really great questions. It's really great to have an engaged audience here. And I would say for those of you that want to connect, you can find me, my website's futureuwealth.com. That's spelled out future, then YOU wealth.com. My email is ryan@futureuwealth.com. In terms of social media, you can find me at Ryan Sterling on LinkedIn. That's probably my number one social media platform.
Sweet. Well, yeah, thank you, Ryan, for jumping on. I think this was incredibly insightful. Really love your perspective from somebody who is a financial planner and has experience in corporate finance. This was, even to hear your presentation, I love some of the nuggets and data you provided. It's really helpful. So thank you, everybody, for jumping on. And I think we should definitely do this again.
It'll be a lot of fun. Anytime.
All right, everyone. We'll see you. Thanks for jumping on.